You know that physical sensation of extreme whiplash?
Oh, yeah. Never fun.
Right. Like, imagine you are a passenger in a car and the driver just suddenly slams on the brakes to avoid this massive collision.
Yeah, your whole body tenses up.
Exactly. You lurch forward, the seatbelt locks hard against your collarbone, your heart is just completely in your throat, you are bracing for impact.
Well, your brain basically floods with cortisol. I mean,
Yeah.
it is pure involuntary fight or flight.
Mhm.
You aren't analyzing the situation anymore.
No, not at all.
You are literally just trying to survive the next 5 seconds.
But then, a split second later, instead of crashing, the driver swerves. They find an open lane, and they just completely floor the accelerator.
Right.
And suddenly you are pinned back against your seat, flying down the highway at like 100 miles an hour. You're totally disoriented.
You don't know whether to scream in terror or just laugh from the adrenaline rush.
Exactly. And if you were checking your brokerage account or trying to manage a portfolio this week, that is exactly the psychological sequence you just went through.
It really was. I mean, it was the absolute definition of market whiplash.
So today we are doing a deep dive into the historic Wall Street trading week of May 4th to May 8th, 2026.
And it is a wild ride.
It is. The stack of sources we are pulling from today paints a picture of a market that borders on schizophrenic, honestly.
Yeah, we've got some very granular daily market recaps, sector performance data, fixed income metrics.
And some incredibly tense geopolitical intelligence reports.
Right, which is where the real friction started.
So our mission today is to unpack this bizarre from conflict to convergence narrative, because I am looking at these numbers and I have to ask, how on earth does a week start with U.S. naval intervention?
And missile strikes.
Right, missile strikes in the Middle East and this very real threat of a global supply chain collapse, only to end just days later with the Nasdaq up nearly 5% to historic record-breaking highs.
Well, we are going to deconstruct exactly how that happened, because it honestly serves as a masterclass in modern market mechanics.
It really does.
This isn't just a story about a lucky rebound, We are going to explore how a specific corporate mechanism, which we'll call the earnings firewall, combined with a massive collapse in bond market fear.
And that basically overpowered the sheer gravity of an international conflict.
Exactly. It's a terrifyingly fascinating look at how institutional capital digests geopolitical terror, recalculates the math, and just decides to buy anyway.
So that military panic on Monday is exactly where we need to start, because to understand the euphoria of Friday, you really have to understand the depth of the fear that kicks this week off.
Oh, absolutely. We are talking about the heavy, suffocating shadow of the war premium.
Right. So Monday, May 4th, the U.S. launches an operation called Project Freedom. Walk us through the physical reality on the ground that morning.
Well, the situation in the Persian Gulf had reached a critical boiling point. The Strait of Hormuz, which you have to picture as this narrow, incredibly vulnerable maritime artery.
It handles what, like a fifth of the world's daily oil consumption?
Exactly. And it was effectively paralyzed. You had an estimated 20,000 international seafarers and dozens of massive commercial cargo ships just stranded.
Wow.
And insurance premiums for maritime shipping through that corridor didn't just spike, they essentially ceased to exist.
Because underwriters won't touch a guaranteed catastrophe.
Right, they just completely pulled out.
So the global energy supply chain is just sitting there completely frozen in the water.
Which forced a highly aggressive physical intervention. President Trump vowed to free those commercial ships, and the U.S. Navy officially began escorting them through the waterway.
This was the initiation of Project Freedom.
Yes, you are taking heavily armed U.S. destroyers and using them as literal physical shields for civilian tankers.
Introducing the immediate, very high probability of a direct, kinetic military confrontation between the U.S. and Iran.
Precisely. I mean, if a single miscalculation happens, if one drone gets too close to a U.S. destroyer, we are in a shooting war.
And the bond market certainly thought so, right?
Oh, without a doubt. U.S. Treasury Secretary Scott Bessent went on national television early Monday to defend the maneuver.
Right. He explicitly asserted that the U.S. military was in absolute control of the corridor.
But, fixed income traders do not trade on political rhetoric. They trade on risk probabilities.
And they priced in a disaster.
Instantly. The 10-year Treasury yield spiked to a 5-week high of 4.45%. The 2-year yield climbed to 3.97%.
Because investors were terrified that a prolonged military engagement would trigger a massive inflationary shock.
Exactly, which would force the Federal Reserve to hold interest rates painfully high for the foreseeable future.
And the stock market felt that immediately. The S&P 500 and the Nasdaq dropped roughly 1% right out of the gate.
Yeah, capital just fled equities for anything that looked like safety.
But the naval escorts were only half the story on Monday. Our intelligence sources highlight a massive regional escalation involving the United Arab Emirates.
Right, the UAE.
And this piece of the puzzle is crucial because the UAE had recently exited OPEC, which fundamentally altered the political and economic loyalties of the region.
It shifted the entire balance of power.
So on Monday, reports broke that Iran had launched missile and drone strikes against the UAE's Fujairah petroleum industrial site.
Yeah.
Why Fujairah? Out of all the targets in the Middle East, why hit that specific facility?
It comes down to geography and leverage. Fujairah is uniquely positioned because it sits on the eastern coast of the UAE, outside the Strait of Hormuz.
Oh, interesting.
It handles a massive portion of the region's bypass pipeline capacity, specifically the Habshan-Fujairah pipeline.
Okay, so this is the critical infrastructure that allows millions of barrels of oil to be exported directly to the Gulf of Oman.
Exactly. Completely bypassing the choke point of the strait.
So hitting that site is a message. It is Iran saying, you think you can just route your oil around our blockade, we can hit the bypass too.
It is a strategic demonstration of reach. Now, the UAE's advanced defense systems managed to intercept the ballistic missiles.
Thankfully.
Yeah, but the drone swarms reportedly caused physical damage to the terminal infrastructure, and the political fallout was immediate.
Right. The sources mentioned unconfirmed intelligence reports started circulating through trading desks.
Rumors that the UAE was attempting to form a new Arab coalition explicitly to pursue regime change in Tehran.
So the market is staring down the barrel of a broadening, multi-front regional war. And the energy markets reacted exactly how you would expect, just pure panic.
Oh, yeah. Brent crude surged to $114 a barrel. West Texas Intermediate, the U.S. benchmark, hit $106.
But the sources show it wasn't just energy. Global food-based commodities spiked right alongside the oil.
They did. We saw soybeans and wheat jump significantly.
And I understand why a war in the Middle East spikes gas prices, but why does it make bread more expensive on a Monday morning?
Well, because modern agriculture is basically a mechanism for turning fossil fuels into food.
Okay, walk me through that.
The Middle East is a dominant global producer of the raw petrochemical materials needed for industrial fertilizers. Nitrogen fertilizers, for example, are synthesized using natural gas. If a regional war permanently cripples those specific supply chains, you aren't just looking at expensive gasoline at the pump today.
You're looking at devastatingly low crop yields for the entire global 2027 planting cycle.
Exactly. It's a massive downstream effect.
And the International Monetary Fund's managing director, Kristalina Georgieva, she issued a very stark warning regarding this exact scenario.
She did. She publicly stated that earlier global growth projections for 2026 were, quote, no longer realistic if the conflict in the Gulf persisted.
And the African Union weighed in with even more urgency. They warned that this renewed escalation was already destabilizing developing economies across the continent.
Because of the immediate, unhedged surge in fuel import costs.
Yeah.
I mean, think about it. If you are listening to this in the U.S., a $114 oil environment is painful.
Very painful.
But if you are a developing nation that relies entirely on imported diesel to run your power grid, $114 oil is a structural economic catastrophe.
The economic scars of that kind of energy shock run incredibly deep across the global south.
Absolutely.
So that sets the stage. We have physical conflict, soaring commodities, and a bond market pricing in a worst-case scenario.
Right.
But that military panic on Monday collided violently with a ghost from the 1970s that appeared the very next morning, Tuesday, May 5th.
That stagflation threat.
Suddenly, we aren't just worried about a war. We are worried about this economic bogeyman.
And it is the single most toxic environment for an equity investor. Stagflation is the vicious combination of stagnating economic growth and uncontrollably high inflation.
Meaning the economy is stalling out, but things just keep getting more expensive anyway.
Exactly. So Tuesday morning, the April ISM Services PMI data drops, and the headline number comes in at 53.6%.
Now, our sources note this is the 22nd consecutive month of expansion for the U.S. services sector. For a casual observer, anything over 50 means the sector is growing.
Right. It sounds like a resilient economy.
But the headline number is a mirage, isn't it?
It completely is. You have to look at the internal components of that report. Yes, the services sector, which makes up roughly 70% of the entire U.S. economy, was still technically expanding.
But the overall reading ticked down from March's 54.0%.
Indicating that the pace of growth is decelerating. The engine is losing momentum. But the truly terrifying data point, the one that had institutional analysts sweating on Tuesday, was the Prices Index internal metric.
What was it?
It was stuck at a staggering 70.7%.
Wow. Help me visualize this, because throwing numbers like 53.6 and 70.7 around can get abstract.
Sure.
Imagine you are driving a heavy-duty pickup truck up a really steep mountain road. You accidentally left the emergency parking brake engaged.
Okay, I like where this is going.
The engine is screaming. It's working incredibly hard. That is the 53.6% services expansion. The economy is trying to move forward.
Right.
But the massive friction from that parking brake, which represents that 70.7% prices index, compounded by the $114 oil, is grinding against the wheels.
Oh, absolutely.
And it is only a matter of time before that friction literally burns the transmission out and the truck just starts rolling backward down the hill.
Let's take that truck analogy even further. The transmission fluid is corporate profit margins.
Okay.
When the prices index sits at 70.7%, it means a massive majority of service providers, logistics firms, software vendors, retailers, they're all facing intense, accelerating input costs.
Because oil at $114 acts like a punitive, unavoidable tax on every single business and consumer.
Exactly. It fuels what we call cost-push inflation. The cost of doing business goes up, so businesses are forced to raise their prices to protect their margins.
And eventually, the consumer simply runs out of disposable income.
They start buying. Demand collapses. The transmission fails.
That is the terrifying reality the market woke up to on Tuesday. But before that reality could fully price into the stock market, Tuesday delivered a massive geopolitical twist.
A diplomatic pause.
Following the intense high-risk naval escorts on Monday, this fragile, temporary truce emerged between U.S. and Iranian forces.
Yeah. President Trump announced a temporary halt in the naval escort effort, allowing room for diplomacy.
While China's foreign minister publicly called for a comprehensive, immediate ceasefire to protect global trade.
And the market reaction was instantaneous. Oil begins this rapid, almost vertical descent. By Wednesday, Brent crude drops nearly 7%, dipping back down near $100 a barrel.
But I have to challenge the logic here. Why does Wall Street forgive and forget a near-war scenario so quickly?
What do you mean?
Well, the sources specifically use the word fragile to describe this truce. Missiles were literally flying 24 hours prior. Are investors just so desperate for a reason to buy stocks that they will pretend the Middle East is suddenly a stable region?
It feels like the market has the memory of a goldfish, doesn't it?
It silly does.
It looks like willful, psychotic ignorance from the outside. But you have to remember, institutional capital does not operate on emotion or memory. It operates strictly on probability modeling. The market was never pricing in a permanent era of world peace on Tuesday afternoon. On Monday, the algorithmic probability of a catastrophic supply-destroying war was priced at, let's say, a 40% likelihood.
Right.
When the U.S. pauses escorts and China intervenes diplomatically, that probability model automatically drops the likelihood of immediate war to maybe 10%.
Ah, so the risk didn't disappear, it just became less statistically probable.
Exactly. Furthermore, institutional commodities traders were looking at physical data. They knew that non-OPEC production flows oil coming out of the U.S., Canada, and Guyana were actually increasing and coming online.
So the moment the immediate threat of a physical blockade in the Strait of Hormuz receded, those traders aggressively unwound their long, speculative positions on oil.
Right. They shifted their models from pricing in a geopolitical supply panic to pricing in a high interest rate demand slowdown.
Interesting. So if the geopolitical heat on Monday and Tuesday was the friction on our truck's brakes, the corporate earnings data we received on Wednesday was the horsepower that allowed the engine to completely overpower that friction.
That's a great way to look at it.
This is where the narrative shifts from international conflict to domestic corporate dominance. As the war premium collapsed and oil prices fell, investors stopped staring at maps of the Persian Gulf and started looking at the actual balance sheets of American companies.
And they were stunned by what they saw.
Completely. Which brings us to a concept that analysts initially called the earnings firewall.
Though, based on the data, pricing conduit is probably a far more accurate description.
Right. The prevailing fear was that $114 oil and a 70.7% services price index would absolutely obliterate corporate profit margins.
But then, Wednesday, May 6th happens. The tech and real economy earnings cross the wire, and they don't just survive, they shine.
Let's look at the ride-sharing giant Uber. This specific case study blew my mind.
Oh, the Uber numbers were incredible.
Uber reports a record $1.9 billion in GAAP operating income for the quarter. I need you to explain this to me.
Okay.
How does a company whose entire foundational business model relies on independent contractors driving gasoline-powered cars manage to post record-breaking billion-dollar operating profits when global oil was just flirting with $114 a barrel?
It seems impossible, right?
The math just doesn't make
It
sense.
seems impossible until you understand the power of algorithmic dynamic pricing. The firewall metaphor assumes a company absorbs a hit to protect the consumer.
But Uber didn't absorb anything.
Nothing. They acted as a frictionless conduit. When the cost of fuel spiked, Uber's algorithms instantaneously adjusted the pricing models for rides and food delivery.
They didn't eat the cost of that $114 oil at all.
No, they passed every single cent of it directly to the end consumer in real time.
And the consumer just paid the higher surge pricing. Like, no one uninstalled the app because their ride to the airport suddenly cost $15 more.
That is the revelation. The demand proved to be incredibly inelastic. Consumers grumbled, sure, but they still ordered their food and they still took their rides.
Uber demonstrated massive pricing power.
Exactly. They proved to Wall Street that their proprietary software could successfully insulate their operating margins from real-world commodity shocks.
And it wasn't just Uber. AMD and Disney also beat their earnings expectations midweek.
Right.
It sent this overwhelming signal to the market that corporate America's balance sheets were fundamentally decoupled from the chaos in the Middle East. If these companies can thrive during a war scare and inflation spike, what can't they survive?
And that realization sparked a massive immediate rally in transport and travel-sensitive sectors. The sources note that United Airlines surged 8% and Delta Airlines jumped 7.4% on Wednesday.
Just on Wednesday, because jet fuel is their biggest variable expense.
It dictates their profitability entirely. The moment the geopolitical truce caused oil to drop 7%, algorithmic trading models immediately revised the airline's forward-looking cost projections downward.
So lower fuel costs mechanically translate to expected profit margin expansion, assuming ticket prices remain steady?
Right. The stock price is adjusted instantly to reflect that future profitability.
Wednesday was an impressive display of corporate pricing power, no doubt, but it was really merely the appetizer for the macroeconomic bombshell that dropped on Thursday, May 7th.
Oh, yes. This is where we get into the AI productivity miracle.
Right. And I hesitate to use the word miracle in financial analysis, but the numbers released by the U.S. government here are historic.
Historic is the mathematically correct term here.
Yeah.
On Thursday morning, the U.S. Bureau of Labor Statistics reported that non-farm business sector labor productivity jumped 0.8% in the first quarter of 2026.
And the internal metric that had economists dropping their coffee mugs was the labor share of output.
Yes.
For you listening, labor share is essentially the percentage of total economic output that is paid out to workers in the form of wages and benefits.
Right.
That number dropped to 54.1%. The sources explicitly highlight that this is the lowest value recorded since 1947.
We are talking about post-World War II economic dynamics here.
How does the labor share of an economy drop to a 79-year low while the economy is still technically expanding? What is the actual mechanism here?
We are witnessing a profound structural transformation in the fundamental relationship between capital and labor. Why is the labor share dropping so precipitously?
Right.
It is the direct result of the rapid, aggressive integration of AI-driven autonomous workflows across the corporate sector.
Companies are no longer hiring junior analysts, entry-level coders, or massive customer service teams to handle growth.
Exactly. They are structurally replacing those future labor costs with scalable software and artificial intelligence models.
Let's ground this. If a software company traditionally needed to hire 50 new engineers to build out a new product line, which costs tens of millions in salaries and benefits,
Right.
they are now buying an enterprise AI coding assistant, hiring 5 senior engineers to oversee it, and achieving the exact same output. The output grows, but the labor cost shrinks.
Precisely. Historically, if a company wanted to increase its output by 10%, it generally had to increase its headcount by a comparable margin.
But that link has been severed.
Completely severed.
Think about AI like a high-end magnetic shock absorber on a specialized mountain bike. The macroeconomic terrain we are riding over the geopolitical threats in the Middle East, the 4.4% treasury yields, the volatile $100 oil is incredibly rocky.
It should be jarring enough to throw the rider right off the bike.
But the rider, which represents corporate profit margins, barely feels the bumps. The AI shock absorber is eating the friction. It allows the company to maintain its speed without breaking down.
That mechanical comparison is crucial. In previous economic cycles, when input costs like energy or raw materials skyrocketed, a company's profit margin would shrink dramatically unless they resorted to mass layoffs.
But mass layoffs usually trigger a broader economic recession as consumer spending dries up.
Today, AI is allowing these companies to achieve massive, sustained productivity gains without expanding their payrolls proportionally in the first place.
They are doing vastly more with significantly less.
Right. This technological efficiency is acting as a profound structural buffer against wartime inflation.
And the data backed up this resilience elsewhere, too. U.S. construction spending rose 0.6% in March, easily beating the 0.2% consensus expectation.
Private residential construction was up 0.8%. People are still pouring concrete and framing houses, even with the two-year Treasury yield pushing aggressively back above 3.89%.
It points to an incredibly stubborn underlying domestic demand.
It shows that the U.S. consumer and business sectors have adapted to a higher rate environment. They aren't waiting for 0% interest rates to return. They are moving forward regardless.
But the fog of war didn't completely lift, did it? Even amidst this euphoric productivity data, Thursday brought some sobering international news that proved the geopolitical risk wasn't just a Monday anomaly.
The diplomatic situation remained highly volatile. Iranian officials publicly clarified that a final conclusion on the U.S. proposal to end maritime hostilities had not actually been reached.
The truce was a pause, not a peace treaty.
Exactly. But far more concerning for the long-term reality of the global logistics industry, reports emerged that Iran had officially created a new bureaucratic entity.
Right, called the Persian Gulf Strait Authority. They set up a governing body for the strait.
Yes, and this authority immediately began circulating strict new rules, inspection protocols, and transit fees for all commercial vessels attempting to transit the waterway.
I see the strategy here. If they can't physically blockade the strait with fast attack boats without triggering a U.S. naval response, they're going to try to legitimize their control over the choke point through aggressive bureaucracy and lawfare.
Right, they are turning a military blockade into an administrative toll booth.
It is asymmetric economic warfare, and the West is reacting to this new reality. In Paris, the G7 trade ministers held a high-stakes emergency meeting specifically focused on securing supply chains for critical minerals and energy away from the Middle East.
They recognize the vulnerability. They are desperately trying to build a new, resilient, rules-based trading system that does not rely on volatile corridors governed by hostile actors.
But reading through your notes on this, you highlight that while friendshoring and securing supply chains sounds incredibly responsible in a political press release, it is actually a massive problem for investors worried about inflation.
Oh, it's a huge issue.
Why is securing our supply chains a bad thing economically?
Because redundancy is inherently expensive. For the last 30 years, the global economy was built on hyper-efficient, just-in-time supply chains that prioritize the absolute lowest cost, regardless of where the goods came from.
Right.
Now, the G7 is deciding that efficiency must be sacrificed for security, building new critical mineral processing facilities in allied nations, rerouting global shipping lanes to avoid the Middle East, subsidizing domestic semiconductor. Manufacturing these structural moves require trillions of dollars in capital expenditure.
So even if the immediate threat of missiles flying over the Gulf pauses, the G7's structural move to physically reroute global trade is a massive, long-term inflationary headwind.
It essentially guarantees that physical goods will structurally cost more to manufacture and transport over the next decade.
Wow. So the era of cheap, frictionless globalization is being replaced by expensive, fragmented regionalization.
Precisely.
Which brings us to the crescendo of the week. Corporate America proved it was technologically resilient. The tech sector is booming on the back of AI.
Right.
But the equity market still needed one final, definitive piece of macroeconomic validation to truly blast off into the stratosphere.
They needed to know the status of the U.S. consumer and the American worker.
And they got their answer on Friday morning, May 8th, with the April jobs report.
This was the singular moment the market realized it had achieved the elusive Goldilocks scenario.
Let's turn to these numbers because they dictated the massive rally we saw to close the week.
Yeah, let's do it.
The U.S. economy adds 115,000 jobs in April. Now, the consensus estimate from economists was only 55,000, so the economy more than doubled the expected job growth.
Huge beat.
Unemployment holds perfectly steady at 4.3%. But the most crucial number in the entire massive report, and the specific metric that sent the S&P 500 up 0.8% and the Nasdaq soaring 1.7% on Friday alone, was the wage growth data.
Right, average hourly earnings.
Exactly. It rose only 0.2% month over month, which actually came in below the 0.3% forecast.
If you are an institutional equity investor managing billions of dollars, you literally could not have engineered a more perfect, pristine macroeconomic data release in a laboratory. It was flawless.
Break down why 115,000 jobs and 0.2% wage growth is the holy grail. On the surface, if I'm a worker, seeing my wage growth slow down to 0.2% doesn't feel like a reason to pop champagne.
Fair point.
Why does Wall Street love it when worker paychecks grow slower than expected?
Because of the mandate of the Federal Reserve. Wall Street doesn't care about the workers' purchasing power in isolation. They care about inflation and interest rates.
Right.
Unpack the Goldilocks concept. It's not too hot and it's not too cold.
Yeah.
If the economy had only added 20,000 jobs, the market would have panicked. That is too cold.
It would signal that the high interest rates were finally crushing businesses and an imminent deep recession was arriving. Equities would sell off.
Exactly. Now, what if it was the opposite? What if the report showed 300,000 jobs added and wages growing by 0.6%?
That is too hot. If wages grow at 0.6% in a single month, it signals aggressive wage push inflation.
Right. Workers have too much leverage, they're demanding more money, and businesses will have to raise prices to cover those salaries.
If the data came in that hot, the Federal Reserve would be forced to aggressively hike interest rates again this summer to deliberately cool the economy down.
And the bond market would revolt, yields would spike, and growth stocks would just collapse.
But 115,000 jobs combined with only 0.2% wage growth.
It threads the needle perfectly. The economy is strong enough that companies are still hiring and people are still working, meaning we avoid a recession.
But the labor supply is balanced enough that employers aren't being forced into bidding wars for talent.
Right. Wages are growing, but slowly enough that they do not threaten to reignite inflation. The cooling wage data was the definitive permission slip the bond market needed to finally relax.
And we saw that. The 10-year Treasury yield immediately eased back down to 4.35%.
Which triggers what our sources identify as the volatility crush.
From a purely mechanical standpoint, this might be the most vital takeaway of the entire week for anyone trying to understand why stocks surged the way they did.
Mechanically, the collapse of volatility explains the sheer, unavoidable force of the Friday rally. It is the invisible engine of the market.
Let's look at the specific volatility indexes. The S&P 500 rate of change turns highly positive. The VIX, which most people listening know as the stock market's fear gauge, drops 6% down to 17.19. But the real story, the metric that actually dictates capital flows, is the MVE index. What exactly is the MVE index, and why does a 13% plummet down to 67.25 matter so profoundly to a tech stock investor?
Well, the VIX measures implied volatility, or fear, in the equity market. But the MV index measures fear in the bond market.
Okay.
Specifically, it tracks the implied volatility of U.S. Treasury yields. For much of the spring leading up to this week, the bond market had been an incredibly chaotic, unpredictable environment.
Yields were swinging wildly day to day as traders tried to guess what the inflation data meant and what the Federal Reserve would do next.
Exactly. And why does bond volatility hurt stock prices? Because of a concept called the discount rate.
Right.
When you buy a stock, especially a high-growth tech stock, you are buying a claim on that company's future cash flows. To figure out what those future cash flows are worth today, financial models discount them backwards using the current risk-free interest rate.
Which is the U.S. Treasury yield.
Exactly. If the Treasury yield is violently jumping up and down every day, the foundation of every single valuation model on Wall Street is shifting like sand. It becomes impossible to accurately price equities.
When institutions can't price risk confidently, they pull their money out of the market and sit in cash.
So when the EMVE index crashes over 13% in a single week, dropping to 67.25, it creates a massive liquidity vacuum.
Fixed income traders essentially looked at the Goldilocks jobs report and stopped panicking. They stopped pricing in a drastic immediate rate hike from the Fed, and they also stopped pricing in a drastic emergency rate cut.
Right. They accepted that interest rates might stay higher for longer, but crucially, they believed rates were finally stable.
The lesson here is fascinating. Stability in the bond market, the sheer fact that the MV index crashed, is currently far more important to equity prices than the absolute level of interest rates.
It completely is. The 10-year yield was still hovering around 4.35% on Friday. Historically speaking, a 4.35% risk-free rate is not a cheap environment for corporate borrowing.
But because the rate stopped jumping around unpredictably, the stock market got a hall pass to deploy trillions of dollars in sideline cash back into equities.
Institutional capital can adapt to high interest rates. It cannot adapt to unpredictable interest rates. The volatility crush provided the mathematical certainty needed for portfolio managers to aggressively buy back into the market.
But just as Friday's closing bell was getting ready to ring on this euphoric, record-breaking domestic rally, the U.S. government reminded everyone that the geopolitical chess match is far from over.
Oh yeah. Before we look at the sector breakdown, we have to talk about the economic fury sanctions.
This was a major, highly aggressive expansion of U.S. economic statecraft, specifically targeting the global logistical networks that support the emerging Iran-Russia-China axis.
Right. Secretary of State Marco Rubio defended a new wave of aggressive sanctions targeting an entity called GISA.
For context, GISA is a massive military-run conglomerate that controls a huge portion of the economy in Cuba.
And the immediate corporate fallout from this specific sanction was staggering. Canada's Sherritt International, a major mining company, was legally forced to withdraw from its Moa Nickel joint venture in Cuba.
They had been operating in that specific partnership for 32 years.
32 years of continuous, highly integrated operations severed practically overnight by a single U.S. Treasury designation.
And you have to understand the commodity at play here. Nickel is not just a random metal.
Right.
It is a critical, non-substitutable mineral required for electric vehicle batteries, energy transition infrastructure, and advanced military defense systems.
And the U.S. didn't stop in the Caribbean. The Treasury Department simultaneously targeted 10 different entities across the Middle East and Asia.
Specifically taking aim at China's teapot refineries. What is a teapot refinery and why is the U.S. targeting them?
Teapots are the independent, non-state-owned oil refineries in China. For years, they have been the primary buyers of illicit, heavily discounted Iranian and Russian crude oil.
Ah, so they operate somewhat outside the official state apparatus, making them harder to regulate.
Exactly. By sanctioning them, the U.S. is attempting to choke off the primary revenue stream, funding the Iranian military apparatus.
This is the aggressive use of secondary sanctions.
Yes. The U.S. is essentially leveraging the power of the U.S. dollar to issue an ultimatum. They are telling foreign financial institutions and global corporations, you can choose to do business with these sanctioned entities in Cuba, Iran, and China, or you can choose to do business with the U.S. banking system.
But you absolutely cannot do both.
Right. And because the U.S. dollar is the reserve currency of the world, companies like Canada's Sherritt have no choice but to comply and abandon a 32-year asset.
Which raises an incredibly important, almost existential question for the future of global finance. You note in your analysis of the sources that this heavy-handed use of secondary sanctions could lead to a deeper systemic decoupling of the entire global financial system.
It doesn't just lead to it, it aggressively accelerates it. If you continually weaponize the dollar-based financial system to enforce U.S. foreign policy, countries that find themselves at odds with Washington even slightly realize they are vulnerable to economic ruin at a moment's notice.
So they have no strategic choice but to accelerate the building of alternative, non-dollar financial architectures.
Exactly. Whether that is expanding the BRICS payment systems or trading oil in local currencies, it heavily heightens the risk of bifurcating the global economy into two distinct, competing trading blocks.
So we have covered the massive macro narrative of the week, the geopolitical terror on Monday, the corporate pricing power on Wednesday, the Goldilocks jobs report, and the bond stability on Friday.
It's a lot to digest.
It is. But now I want to look beneath the surface because the headline numbers, the S&P 500 gaining 2.75% and the Nasdaq soaring 4.70%, paint a picture of universal euphoria.
But those index-level gains actually mask a brutal, fascinating internal tug-of-war.
It really was a tale of two entirely different markets operating simultaneously. Let's break down the specific sector divergence, because this is where the theory meets the reality of portfolio management.
Yeah, let's look at it.
The sources outline a massive split between what we can call the sensitive sectors and the cyclical sectors. Technology, tracked by the XLK ETF, soared 8.31% on the week.
That is a massive, almost unprecedented weekly gain for the heaviest weighting in the S&P 500.
Consumer discretionary, the XLY ETF, gained 2.11%. But on the flip side of the ledger, the industrial sector, the XLI, plunged 6.21%.
And traditional utilities, the XLU, dropped 3.56%.
This stark divergence is the defining characteristic of the current macroeconomic environment. We are witnessing a fundamental split in how capital treats different types of businesses.
Right. I categorize this as the divide between digital cyclicals and physical cyclicals.
Okay, define those terms for me. What makes a company a digital cyclical?
Technology firms, software developers, and certain consumer discretionary companies are digital cyclicals. They benefit immensely from having incredibly low physical overhead.
Their profit margins aren't tied to the price of diesel fuel or the cost of shipping containers.
Exactly. When the movie index crashed and the 10-year Treasury yield stabilized midweek, it acted as a massive green light for these AI-centric megacap stocks.
Because they are what we call high beta assets.
Meaning they move with amplified volatility compared to the broader market. So they exploded upward the moment the risk-free discount rate stopped fluctuating. Their future cash flows suddenly looked far more attractive, and they are heavily burdened by maritime logistics.
Right. If you are Microsoft selling enterprise AI software subscriptions, you don't really care what the maritime shipping rates through the Strait of Hormuz are doing.
Nope.
Your product moves over fiber optic cables, not cargo ships.
Precisely. They are insulated from physical world friction, but contrast that reality with the industrial sector, the physical cyclicals.
Companies that manufacture heavy machinery, build physical infrastructure, or manage complex global supply chains.
They plunged over 6% this week because they are facing a severe, unavoidable margin squeeze. They are trapped by high producer price index inflation, meaning the raw materials they need to build their products cost significantly more.
And simultaneously, they are dealing with the absolute nightmare of global maritime logistics disruptions caused by the Middle East tensions.
Exactly. They cannot use software to escape the physical reality of the supply chain.
But here's the piece of the puzzle I just don't understand. If institutional investors are so incredibly confident in the economy, if we have this pristine Goldilocks jobs report and the Nasdaq is hitting record highs, why are traditional safety sectors like utilities and healthcare being aggressively dumped?
It's a great question.
I mean, healthcare dropped nearly 1%, utilities dropped 3.5%. If the market is confident, shouldn't a rising tide lift all boats, or at least keep the traditional safe havens steady?
In a historically normal economic cycle, you would be absolutely correct. But we are not in a normal cycle. Capital isn't just seeking general growth. It is rotating entirely into AI productivity as the new definitive safe haven.
Wait, you are telling me investors view highly volatile technology stocks as a safer investment than a utility company that provides electricity to homes?
In this specific macroeconomic environment, yes. When risk-on sentiment violently returned to the market this week, institutional portfolio managers essentially used defensive sectors like utilities as a giant ATM.
Wow.
They systematically sold off their stable, dividend-paying utility stocks specifically to raise the cash needed to fund their aggressive purchases of high-growth technology stocks.
Because the jobs report proved that a recession wasn't imminent, these managers no longer felt the need to hide in slow-growth utilities.
They realized the only way to beat inflation and capture alpha was to chase the AI narrative.
That is a wild paradigm shift. Tech is the new safety. And we saw a very similar, bizarre bifurcation play out in the commodity markets this week, didn't we?
We did. It was a violent rotation in hard assets.
Let's look at the numbers. The Bloomberg Energy Subindex, which tracks broad energy commodities, plunged 8.33% for the week. Brent crude ended near $101, WTI near $95.
Right, the entire Hormuz premium evaporated as the geopolitical fears subsidized.
But look at the metals. Precious metals surged 5.29%. Industrial metals gained 2.86%. Why did gold and silver explode higher while the oil market was violently crashing?
Because gold and silver managed to act as the ultimate dual-purpose assets this week. They benefited from two completely different market psychological states.
Oh, interesting. How so?
Well, on Monday and Tuesday, when the world genuinely thought we were heading into a kinetic war in the Middle East, investors aggressively bought gold as a classic geopolitical hedge. It is the oldest safe haven in the world.
A place to park your capital when missiles are flying and fiat currencies look vulnerable.
Right. That makes logical sense. Fear drives gold up.
But then the paradox happens.
Yes. When the diplomatic truce was announced and the war fear rapidly subsided, gold didn't sell off. Why? Because on Friday, When the Goldilocks jobs report was released, investors bought gold for an entirely different reason.
They bought it as a monetary play on the Federal Reserve.
Exactly. The soft wage growth in the jobs report meant the Fed was likely to pause their interest rate hikes. When the Federal Reserve stops raising rates, the U.S. dollar historically tends to weaken against other global currencies.
And because commodities like gold are priced globally in U.S. dollars, a weaker dollar makes gold cheaper for foreign buyers, which drives the price up.
So gold caught a massive bid on pure geopolitical fear early in the week, and then caught a second massive bid on monetary easing optimism late in the week.
It was the perfect storm. It just couldn't lose. Which brings us to the final and perhaps most critical segment of our deep dive, the valuation collision.
Looking ahead to the trading week of May 11th through the 15th.
We survived the war scare in the Gulf. The corporate pricing conduit held strong. The jobs report was literally perfect, and the bond market calmed down. But now, as we look at the week ahead, we face a mathematical threat.
We are entering next week priced for absolute, unforgiving perfection. The equity markets are stretched to the absolute mathematical limit.
Let's talk about the Shiller PE red flag. The Shiller PE ratio, which, if you aren't staring at financial terminals all day, is a valuation metric that looks at inflation-adjusted corporate earnings over the past 10 years to smooth out the noise of the business cycle.
Right.
Well, it crossed back above 42x this week. Specifically, it hit 42.05. You note in the source analysis that this puts the broader market in the 99th percentile of historic valuations.
Yes. To give you the necessary historical context, the long-term average for the Shiller PE over the last century is somewhere around 17.
And we are at 42.
The only other times in recorded financial history that we have seen broad market valuations hit this extreme level were the absolute peak of the dot-com bubble in 2000 and the peak of the post-COVID zero-interest rate stimulus frenzy in late 2021.
Both of those periods preceded violent market corrections.
They certainly did.
I have to ask the obvious question then, acting as the proxy for anyone looking at the retirement account right now. If the Shiller PE is at 42, are we just paying higher and higher irrational premiums for the exact same underlying corporate earnings simply because a CEO says the word AI on an earnings call?
That's the fear.
Isn't this exactly what multiple expansion means? And isn't this exactly how financial bubbles burst? If we're in the 99th percentile, how much higher can this balloon realistically inflate before the rubber snaps?
It is the multi-trillion-dollar question hanging over the market right now. The term multiple expansion simply means the stock price is going up faster than the company's actual profits are growing. Investors are willing to pay a higher multiple, say $42 for every $1 of earnings, instead of $20, because they believe the integration of AI will eventually make these companies exponentially more profitable in the future.
They are paying for tomorrow's assumed efficiency today.
But your skepticism is entirely warranted. When the market is priced at 42 times earnings, it becomes incredibly fragile. At a 17 PE, the market can absorb bad news.
But at a 42 PE, any slight disappointment in macroeconomic data, any failure to meet sky-high expectations, can trigger a violent, rapid mean reversion.
Precisely. And looking at the economic gauntlet scheduled for next week, there are plenty of data landmines that could trigger that exact reversion.
Let's walk through the calendar. What are institutional desks bracing for?
Well, Monday kicks off with the New York Fed one-year inflation expectations survey.
Yeah.
This is a crucial leading indicator. It tells us what consumers actually believe prices will do.
If consumers expect high inflation, they demand higher wages, which creates a self-fulfilling prophecy.
Exactly. Tuesday gives us the Germany ZEW Economic Sentiment Index, which is critical for understanding how European industrial resilience is holding up after the recent energy supply disruptions and $100 Brent crude.
But Wednesday, May 13th, is the undisputed main event of the week.
Wednesday morning brings the U.S. CPI, the Consumer Price Index. Because the market rallied so aggressively on Friday, based entirely on the assumption of a Goldilocks scenario, cooling inflation and steady growth, there is absolute zero room for an inflationary surprise in this CPI report.
Right.
If the core CPI number beats expectations, if it indicates that inflation is becoming structural and sticky again despite the high interest rates, the equity markets will react violently to the downside.
You also have the U.S. real earnings report on Wednesday, which will show us if consumer purchasing power is actually keeping up with a world where oil is still hovering near $100.
Then Thursday, May 14th, is the U.S. PPI, the Producer Price Index. This is the pipeline inflation we discussed earlier.
Exactly. This is the specific data point that explains why the industrial sector dropped 6% this week.
The PPI data will reveal if those industrial profit margins are going to continue to be relentlessly squeezed by high raw material costs and maritime shipping disruptions, or if relief is coming.
And finally, Friday, May 15th brings U.S. retail sales.
The definitive, undeniable test of the American consumer. With credit card interest rates at historic highs and the lingering effects of the energy spike, the market desperately needs to see if discretionary consumer spending is finally cooling off.
Or if the consumer is somehow still willing to carry the entire U.S. economy on its back.
We also have some incredibly consequential corporate earnings to watch that will specifically test this AI productivity narrative. Cisco Systems reports on Wednesday.
Cisco is vital. They are the plumbing of the internet. The market will be aggressively scrutinizing their forward guidance on enterprise networking and infrastructure spending.
It is a fundamental metric for determining if the massive AI hardware build-out is sustainable or if corporate budgets are starting to tighten.
And Applied Materials reports on Thursday.
A critical read on the semiconductor manufacturing equipment cycle. NVIDIA designs the chips, but Applied Materials builds the machines that make the chips.
We need confirmation that the explosive momentum we saw in chipmaking back in April is actually accelerating into the second half of 2026.
Oh, and keep a close eye on Constellation Energy on Monday. The market needs to see how the volatile swings in crude prices and energy markets are impacting domestic utility revenue streams.
So if you are a portfolio manager staring at this setup, what is the forecast? How do we synthesize all of these conflicting signals?
The dominant inertia of the market right now is unequivocally risk-on. The sheer mechanical drop in both the VIX and the MOVE index indicates a broad return of institutional complacency.
Okay.
The pain trade, which is Wall Street slang for the direction that catches the majority of market participants off guard and forces them to buy to cover their positions, is still to the upside.
Yeah.
So mechanically speaking, I would expect a continuation of the upward momentum for the first half of the week.
The market wants to test those new all-time highs again.
Yes. The equity market has its volatility hall pass, and momentum is a powerful force. But by Thursday or Friday, extreme structural vulnerability sets in.
Because of that valuation collision we discussed.
If the Wednesday CPI data comes in unexpectedly hot, or if Friday's retail sales significantly disappoint, the sheer gravitational weight of a 42 Shiller PE could force a very sharp, sudden period of aggressive profit-taking or sideways consolidation.
The ceiling is very, very heavy right now.
Very heavy.
So what does this all mean for you listening to this deep dive? Let's bring all these complex threads together.
Let's do it.
The trading week of May 4th to May 8th, 2026 proved one massive overriding theme on Wall Street: growth over gravity. We literally watched the financial ecosystem digest U.S. naval operations, ballistic missile strikes, a 70.7% services price index, and the credible threat of a global supply chain collapse.
And the market simply recalculated the odds and shrugged it off.
Because the rapid de-escalation and falling oil prices midweek acted as a massive, unexpected corporate stimulus.
And AI technology proved it was no longer just a speculative buzzword. It became the ultimate, measurable, defensive shield against wartime inflation and labor costs.
It was a week that fundamentally challenged every traditional assumption about how capital markets are supposed to price geopolitical risk.
Which leaves us with a fascinating and, frankly, deeply provocative macroeconomic reality to consider.
Right.
Historically, for the last 100 years, when the world got scary, when regional wars broke out, or inflation spiked uncontrollably, investors sought safety in the boring, physical reliability of utility companies and government bonds.
But today, the data undeniably shows they are rotating entirely out of utilities and bonds to aggressively buy mega-cap technology stocks.
The ultimate irony. High beta tech is the new safety.
Exactly. But I will leave you with this final thought. If the Shiller PE is sitting at a historically stretched 42, and the absolute most expensive, highest growth digital assets on Earth are now universally considered the safest places to hide your money during a geopolitical crisis, what happens to the entire foundational architecture of the stock market if the AI narrative finally hits a speed bump?
That's the scariest question of all.
If that technological shock absorber keeping this car on the road suddenly fails, where does the capital run to hide?
That is the multi-trillion-dollar question moving forward.
Yeah.
From the pure whiplash of Monday's war fears to the adrenaline rush of Friday's record highs, it has been a historic, exhausting ride.
But when you are flying down the highway at 100 miles an hour with the pedal to the floor, you better hope the road ahead stays perfectly smooth.
Let's hope.
Thank you for joining us for this deep dive into the markets. If you enjoyed unpacking these sources with us, make sure you are subscribed so you don't miss our next deep dive. We'll catch you next time.